Hey everybody, it's Tradius Trades here, back with another red pill for you, another setup market with the commitment to trader strategy. Now, before we get started, just want a quick disclaimer. None of this is investment advice. This is educational and informational only, and I'm not making investment recommendations to buy or sell any of these things. And you need to be aware that trading these markets involves significant risk. You could lose some or all or more than all of your money in these markets. And you need to do your own research before making any of these financial decisions. And I have no liability for any of your losses or damages resulting from the information provided in this video. And secondly, in acknowledgement, I'd like to acknowledge that the concepts which I'm teaching here, which I successfully used to speculate in these markets, were authored by none other than the legendary Larry Williams. I give him full credit for authoring these concepts, and I am very thankful to him for sharing them with the world. And I think there's very few better ways to look at these markets and understand what's going on in these markets. So starting off here, we're going to talk about the grains. There's been a lot of things shaking in the ag commodity commitment to traders setups lately. If you follow my channel, you'll see that wheat has been set up for long. So I've already talked about wheat. This week, we're going to talk about primarily soybeans and a little bit about corn. So soybeans and corn are both set up for shorts. So basically, we're going to talk a little bit about comparable strength and placing only one bet instead of taking a trade in each of those commodities. Because essentially, if corn and soybeans are both set up to be short, you're essentially taking a short trade on the grains. Now, if you took a full risk percentage on each of those markets, you're essentially doubling your risk because you're taking them on essentially the same trade. So what we're looking to do here by picking the right market to place one bet, we're going to manage our money better because we're going to place one bet and not over risk by trading a correlated trade. And also, it's going to likely increase our odds of picking the one that's going to move the most in our favor. So let's talk about what I'm talking about here is comparable strength. So we have two markets within the same family, which are grains, and they're both set up for shorts. So we want to place one bet on these markets. So what we're going to do is take a look at the price action. So we know the fundamentals underlying these markets suggest we're set up for shorts, but let's look at that setup, that fundamental setup in relation to what the price has been doing. So what I want you to pay attention to is we're going to first of all look at the rolling contract on soybeans. And what I want you to pay attention to is this high here, May high. I want you to also look at this September high. Okay, so that's soybeans. We see soybeans has come nowhere near the May high, and it just barely took out October's high. Now let's head on over to corn. Here's the May high, and there's current price, and here's the October high, and there's current price. So what do we see is different? We see soybeans is comparably weaker than corn. Soybeans has failed to take out the May high by a long ways, and it just barely got above the October high. What we see from corn is more than taken out the May high and way exceeded the October high. So what that tells us is corn is comparably stronger than soybeans. So if we're looking to short something, do you want to pick the market that's been stronger, or do you want to pick the market that's been weaker? And the answer is, generally speaking, the one that's going to continue being weaker is the one that's already weak. Some people think because this market's gone up further, it's got more room to go down, and that's not the truth. The thing you want to do is you want to align yourself with the weaker ones when you're looking to short. So looking now at the rolling contract, we see here's the October highs, and soybeans have come nowhere close to those highs. Rolling contract on corn, way above October's highs. So that's a little introduction here. Why would I pick soybeans instead of corn? Well, I'm picking it because the price action tells me that soybeans is weaker. Okay, and now without any further delay, let's get into the usual analysis here. So where we start, always the commitment to traders commercial index. 26-week look back shows us, this is corn. I'll get back to soybeans here. Here we go. Commercial index on the 26-week look back. We see the red line here. The commercials are very short relative to their last 26 weeks worth of positioning. So that's bearish check mark number one. Now taking a look at the net open interest. So this column here shows red lines commercial positioning. Green is small specs, blue is large specs. So I want you to pay attention to the red line here. So what's important to pay attention to with net positioning is when we see commercials taking out a previous extreme in their positioning. We see a pretty obvious extreme got put in here back in late May, early June. The commercials got extremely short the soybean market. And what did that coincide with? Coincided with a major high in the marketplace, preceded a multi-week super mega down move. Okay, so right now we're more short than they were at that point in time. Now, something else you want to take into consideration is how does the positioning relate to the price? And what we can see here is that we are lower in price right now in soybeans than we were back here. Yet the commercials are even more bearish than they were at higher prices. So if they're more bearish than they were back here at even lower prices, that's a strong sign that the commercials, the super smart people that are setting the trends for these markets, don't want soybeans, and they're selling them heavily up here. And that's bearish code number 2. If we head on over here to take a look at open interest on soybeans, we see that soybeans open interest has been going up for weeks. And so when open interest is increasing, we need to ask the question, who's driving the open interest increase? And we see what's happening is the commercials rather, the red line, are getting out of the market. So if open interest is increasing while the commercials are getting out of the market, that must mean that this open interest increase is being driven by the large speculators getting more and more long. And that is a bearish code. Okay, so heading back over here, I'm going to take a look at sentiment. We see that last week we were at a bullish extreme in sentiment from investment advisors. So it's not in there this week. It tagged down here, but this is what I'd call a hangover effect. So if the main thing we're looking for is a juxtaposition between the commercials positioning and the investment advisors sentiment. And we see the commercials are selling heavily, while generally speaking, the investment advisors are telling everybody to buy soybeans. That is a nice juxtaposition. That's a bearish code. Again, looking for shorts for this market. Now heading on over to our valuation measure screen back here, we see that soybeans are overvalued relative to the price of treasuries, gold, and the US dollar. So we're overvalued relative to all 3 of the metrics that we use to measure valuation. We also see a supplementary indicator. The stochastic is very, very overbought. So there's another code in our process to decode the soybean market. Now heading back over here, there is some distribution going on in this market. So we see price here, and the green line here overlaid on the chart is price, open interest, and volume. So what we see here is last week we had a few daily candles making higher highs, but what do we see now is the POIV making lower highs. So there's a divergence here, which is suggesting that this market is starting to be distributed. Who's distributing it? Well, we already know that based on the fact that the commercials are heavily selling at these levels. We know that this is being heavily sold by the smartest people in the business. So we have distribution in the marketplace. And then to end it all off, we have the Williams %R in a sell zone. Now, what else is also super important about this trade? It's different than, for example, the wheat trade, is that this trade is in alignment with the dominant underlying trend. So the 52 period downsloping red line, that's showing us, and it's pretty obvious just looking at the price, but this is a downtrending market. So this setup to sell soybeans is in alignment with the overall dominant trend. Compare that to wheat, for example, where the market's trend is clearly down. The long setup is a counter trend trade on wheat, whereas this is in alignment with the trend. So I like that a lot as well. This is in alignment. The only thing that's not in alignment worth pointing out, and it's a bit of a teaching point, is that the true seasonal down here shows that the true seasonal tendency for soybeans is to go up from now until May. So that's not in alignment with our trade, but it's very important to realize that true seasonal is the last thing that we look at. If it's not in alignment with the positioning, it doesn't negate our setup. It doesn't make us not look for the trade. The reason being is true seasonal shows us what has happened in the past, whereas the positioning, extremes in positioning, tell us what real people are doing with real huge sums of money right now in the present moment. So what's happened in the past gets trumped, or this takes higher priority. Positioning always takes higher priority over the true seasonal, and the cycles. So that's it. That's why I'm looking to short soybeans if we do get a confirmed trend change on the daily. And that's just another thing to be clear about. This video isn't saying I'm just going to go short soybeans on the open. What it means is if we get a confirmed trend change on the daily, and there's a number of ways you can determine a trend change. Once we get that confirms the trend has changed and you enter the trade. So that's basically it. If you have questions about how to trade commitment to traders strategy and you want to learn more, shoot me an email at tradiustrades@gmail.com. I also have a Discord where I openly share my views on the market and openly discuss with a great group of people. If you'd like an invite, shoot me an email to the email I just mentioned. I'll get you in there. And I hope you guys have a great week. And thank you very much for listening.